Dear clients, welcome to PhillipCapital's Weekly Market Watch. I'm Benjamin, Analyst from Phillip Securities Research. Today, I'll share with you the full year FY13 results and FY14 outlook for the Singapore banking sector. The Singapore banking sector has produced good sets of results thus far for FY13, despite macro headwinds during the year. We remain overweight on the Singapore banking sector and expect a moderately positive float ahead on the back of signs of recoveries in major markets, with DBS Group Holdings Limited remaining our top pick for the sector. First up, for DBS, year-on-year results excluding its one-time items have ended 4.2% higher. Net interest income grew strongly despite a low interest rate environment and depressed but stable net interest margin, underpinned by strong broad-based loans growth of 18%. Fee income shows strong traction, particularly in wealth management and trade-related fees. Non-interest income was supported by strong customer flows, supporting weaker trading in line with market volatility. DBS Hong Kong's net profit grew 90% year-on-year, showing DBS strength in tapping into the Greater China market. Full-year dividends is 58 cents, 2 cents higher than last year. OCBC year-on-year results, excluding its one-time items, have ended 2.1% lower. Core banking income was strong as net interest income showed good growth, with a depressed but stable net interest margin, driven by strong broad-based loans growth of 18%. Fee income shows strong traction, particularly in wealth management from the strong distribution channels and trade-related. Bottom line was however hurt by mark-to-market losses from Great Eastern's non-participating fund, as we have emphasized and expected over the last few quarters. OCBC has also been growing their fixed deposits and their CASA balances actively. Full-year dividend is 34 cents, 1 cent higher than last year. UOB year-on-year results have ended 7.4% higher. Net interest income was robust, with loans growth at 17% and net interest margins has picked up 3 basis points from the last quarter. Fee income, as we have expected, has shown very strong double-digit growth at 26%, a testament to their strong business bank and regionalization agenda. Non-interest income was hurt by market volatility. We note that UOB has the lowest CASA deposit ratio, and to avoid paying more in the fixed deposit space, UOB will try to grow their CASA balances to prepare for funding pressures. Full-year dividend is 75 cents, 5 cents higher than last year. The banks have been growing their loan book at a healthy momentum thus far, and we expect them to meet their guidance of high single-digit growth for FY14, as loans growth moderates from little room in Singapore and dependency on overseas growth. Mortgage origins have fallen about 30 to 40%, and the banks have placed a benchmark figure of being able to withstand a 30% price correction in the property market. Net interest margins should continue to be stable, as the short end of the yield curve is not expected to increase till 2015. Fees and commission will continue to be a key driver for the bottom line, as they focus on trade finance business. Expenses are expected to rise with an increase in staff cost and expansionary cost. Asset quality is expected to remain intact. We still emphasize caution on the unpredictable ASEAN front and China. We wrap up our presentation on the Singapore banking sector by emphasizing our ratings on the 3 banks. DBS and UOB remains at accumulate with revised target prices of $18.48 and $22.33. OCBC is still at a neutral at revised target price of $10.17. DBS remains our top pick for their strong deposit franchise, low price-to-book valuation, and low exposure to ASEAN. That is all we have for you today. I'm Benjamin from Phillip Securities Research. Tune in for more Market Watch videos.